We're going to work our way through the rest of the problem in this video, and that starts with preparing an amortization schedule for the lessee given the terms of this lease. And this is certainly necessary and helpful for the lessee as they would then proceed with the lease and then subsequently need to record interest expense and have the right lease liability and the leased asset values on their balance sheet. So anyhow, what I've done is down here I've got a little template. It's an amortization table. Well, you can see most of it. I think some of it might be being cut off just the name of the balance. So anyways, the lease was entered into on January 1st, 2016, and at that point in time we didn't make, well, we did make a payment. We did it kind of in two steps, right? This, you remember from the first portion of the problem, you can refer back. We recorded a lease liability of $625,483.20. So that was the outstanding balance of the lease. And then on that same date, we made a payment of $120,000. We said at that point in time no interest was accrued because we just entered into the lease. So the entire amount of that payment reduced the lease liability. So the liability started at $625,483 and it was reduced by the $120. So the outstanding balance as of that day is $505,483.20. Okay, so every 6 months subsequent for 6 payments, so July 1st of 2016 is the second payment, January 1st of 17 is the third, 7/1 of 17 is the fourth, 1/1/18 is the fifth, 7/1/18 is, so those are 6 payments. So the contract says you make these payments over and over and over again. So my amortization table will reflect that. Now my interest expense is going using the effective interest method. Remember the rate was 12%, however that's an annual rate. So we're calculating the amount of interest expense. We cut that in half because we're making semi-annual payments. So you take the beginning balance, $505,483, times this 6%. So for that 6 months, there were $30,000 of approximately $30,000 of interest. So the decrease in the liability is the difference between the 120 and the 3329. That's logically how much of the payment is left to apply to the outstanding lease liability. So I take that $505,483 and I subtract the amount that I've just said I'm going to reduce that liability by. And so now this becomes a very redundant process. The next period, part of this payment, is going to be interest. So again, 6% of that beginning balance. And then the payment of 120, subtract out the interest, is how much my lease liability decreases. So that 415,812 gets reduced by that amount. Now I can just take and copy these formulas, and this is a nice thing with Excel. I can tell if I did it right, because the ending balance should be 0, or it's close to 0 because of a rounding error here. And I know I did it correctly then, or at least my math works out to amortize the lease liability down to 0. And I know subsequently how much interest to record and how much of the lease liability to reduce as a result of each of these payments being made. So that's the answer to the second requirement. Third requirement says, okay, now take this date here, July 1st of 2016, and record this payment for me. Alright, so we know we're going to have to pay cash. I guess that's the easiest one. My cash goes down by $120,000. And that payment is split between interest and the lease liability. So I would have interest expense of $33.29, and the lease liability decreases as well by this amount. So that's the entry for that payment. And then they throw another one in here. They say, okay, at the end of that year, 12/31 of 16, there's no payment made. You can look at our schedule here. The payment closest to be made to that date is January 1st of 2017. However, this presents a problem. This goes back to the need for accrual accounting, and the matching principle holds true here. What I mean by that is that this first year's worth of interest is only 30 grand, and that's not accurate because we had a whole year we borrowed this money. We've only reflected 6 months worth of interest. You know, it's not logical if you add in 2017 these two amounts together that you'd have more interest in the second year of 30, almost $45,000 compared to the first. That's not logical. So you have to adjust the interest on, because this 30,000 only reflects the time that passed between January 1st and July 1st. So we have to reflect now the second 6 months worth of interest, which is actually from July 1st to January 1st of the next year. So this $29,000, we record that interest expense in 2016. Even though we don't pay it, we report all of that interest expense in that year. We don't pay it yet, so we have interest payable. So this is the adjusting entry, and here's the entry made on payment. So that brings us all the way through the end of what I would consider a fairly easy lease problem, only looking at it from the lessee's perspective.